Hey, my name is Tucker Kraus, and welcome back to my channel. In today's video, we're going to be taking a look at URG. Now, this is one of the companies I still haven't looked at in the uranium sector. I've still got a couple more companies to go, Cameco, Energy Fuels, and NextGen probably being the three most notable. But aside from that, let's get into it. Since there's been a lot of weakness lately, let's look at some more companies, see if some of these companies are worth it to buy with, considering not all of them, but some of these companies are definitely approaching their August lows, though not many are quite there yet. Maybe we'll get there, or maybe we won't. We'll have to see. But anyways, UR Energy, it trades with the ticker URE on the TSX, or better known by the ticker URG on the New York Stock Exchange. It's trading at $1.50 Canadian or $1.20 USD, with a market cap of $324 million Canadian or $259 million US, with 1646 CAD per pound or 1315 USD per pound. So definitely very, very high on the price per pound, but I'll get into it later. There's definitely a reason for that very expensive price per pound. But speaking of how everything's been getting beaten down lately, maybe, just maybe, we're approaching a bottom here, since right here from Uranium Insider, reportedly Rick Rule is buying heavily this week. So you know what, maybe he's coming in, he's buying the dip. Maybe that could mean an indication this is a bottom, especially with that presentation he's going to be hosting on Saturday. So something I definitely will see with the max chart right here is it doesn't seem like there wasn't major share dilutions. Just a lot of these charts, you'll look at the 2008 peak is way up here and it's just flat. You can see it still climbed a good bit. So it seems the share dilution wasn't as horrible as a lot of the other companies. That's something I like to see. And so then we look at the 6 month here, not quite, but definitely getting close to those August lows back here. Now, again, I'm just kind of judging these charts. Basically, I still don't know TA that well. I'm going through Andy over at Finding Value Finance's playlist on TA, and I'm trying to figure it out. And so hopefully, you know, if I can get like 10% as good as him, you know what, I'll take it. And yeah, obviously go subscribe to Finding Value Finance if you aren't already. That's kind of random, and I just threw that in there because I'm trying to figure out TA, and he's a great. You should watch him if you like uranium and commodities and all that. Anyways, let's get into some presentation snips. So, on their Lost Creek property here, the 8 years of production, and they've had about 90% recovery rate, and so we can keep going through here. We can also see that they've had massive resource growth, at least from 2011 through to 2016, so it's possible that it's even more than what they last were measuring with back in 2016. Perhaps there's even more that they haven't discovered yet. Who knows? Operational experience leverages ramp up. So planning ramp up and production at Lost Creek. Of course, they've got a lot of it fully permitted, and they're working on construction and drilling in some of the other sections at Lost Creek, and they still have a whole bunch of other remaining mine areas that are ready to go once the uranium price is there, or at least they can start developing. And then Shirley Basin, which is their other main project, is construction ready. They have all their major regulatory approvals received, so that's good to see, and so future production to be supported by exploration and development of UR Energy's portfolio properties in Wyoming. So they actually cover it right here. How I noted on the stock charts, it looks like the share dilution wasn't that bad. We can see them compared to the historic dilution by a whole bunch of different companies. They did not have to dilute nearly as much, which is good to see, because you don't never like share dilution. And you know what? They have it right here. The best predictor of future behavior is past behavior. So you know what? If they haven't diluted, there's a good chance they won't do it. That's part of the reason I love Global Atomic, is because they don't dilute and have really solid share structure. So UR Energy's market position, we can see here, it's actually still really good share structure, only 206 million shares outstanding compared to that market cap, with only 12 million options and only 12 million warrants, so actually pretty good. And they actually have a couple 100,000 pounds of uranium ready to go, so that's always good to see. So let's get into their first project here, Lost Creek. It's got 19.7 million pounds in the ground with a fairly small royalty of 0.05% net smelter revenue royalty, with a 0.0453% parts per 100 grade. And so on this one, because it is currently producing just at a very minimal amount, Lost Creek, they're just waiting for that higher U price to ramp up to full production potential, and they estimate the mine can produce for another 12 to 15 years, and with about 13.8 million more pounds to be produced. And so we don't have to worry about initial capex, and their sustaining capex overall is going to be very low, only $9.8 million, and they have fairly low OPEX of $14.58. And so, yeah, I'm going to assume in the DCF for just the fair value purposes that they'll ramp up in 2024. Something else to note, though, is this is from a PA from 2016, so it's fairly out of date, and a PEA is already less accurate than a PFS or DFS, so take these numbers with a grain of salt. So onto their current development project alongside that, Shirley Basin, 8.8 million pounds in the ground with a slightly larger royalty of 0.07%, significantly higher grade at 0.2% parts per 100, with a capex initial of $30.6 million with $80.9 million in capex total, but a lot of that is just from additional development that they'll be doing and not necessarily sustaining capex. You can see right there, sustaining capex only $0.7 million, very low, with OPEX being very similar at $14.30, so just ever so slightly lower. And then we go 3 years for construction and about 8 years of production. And that same thing, I'm going to assume they begin construction in 2024. So just to total it up here, 28.5 million pounds of uranium at a fairly low grade overall of 0.1265%, though it's definitely higher than lots of, say, the African uranium mines. And so this is the total mineral resource. And so they do also have some exploration assets with 2 uranium and 1 gold for exploration assets. But of course, those don't have a mineral resource or a PEA or anything. But that's just something to note when you're judging this company, is that it's not just what we looked at there. They do have some exploration stuff. So to look at the DCF here, it actually looks pretty decent. At current uranium price, they are profitable, though significantly overvalued. At $60, that remains the same. At $66, we see their fair value. And at $80, we do see a decent amount of upside. Now, of course, that is to say, one thing is that you have to also look at the price per pound with that. The price per pound was very, very pricey, but they actually did quite well in the DCF, since most of these companies, even at $80 uranium spot price, are actually overvalued. And of course, the usual 50% capex and OPEX inflation with a 10% discount rate, so they're all now already naturally conservative. Something else to note, like I said earlier, the outdated PEAs make it tough to say how accurate this is. And for example, Shirley Basin, the sustaining capex was calculated using November 2014 CPI. Yeah, you can see I imagine that did not hold up well. I'll put it that way. So that's basically the end of the video. So overall, it does seem, I do like the share structure. They look really solid there, and it looks like they're pretty much ready to go, which is good to see, similar to Boss Energy. Just, you know, they're going to be ready to go. They only got that major advantage, so that would explain the pricey price per pound, because, you know, they have that big advantage ready to go, and not to mention they're in the U.S. and Wyoming, so fairly safe jurisdiction there, and it's not necessarily very anti-nuclear and, like, anti-mining and stuff like that, which is an issue with a lot of the Athabasca Basin companies, because obviously Trudeau, not a fan of that. But either way, now I'm kind of rambling. Of course, do your own research, all that kind of stuff, and I will see you next time.